Welcome everybody to this evening's presentation, using options for consistent returns. My name is Don Kaufman. A few things I'd like to cover up front. First of all, we do have a little bit of a risk disclosure. We're not financial advisors or a broker-dealer. That was where, again, I spent a large portion of my career was in the brokerage world, the previous 15 years, which I'll kind of discuss here momentarily. The copyright disclaimer, this is ours, this is not yours. But the question that always comes up is this going to be recorded? Of course it's going to be recorded. In fact, I just recorded me saying it's going to be recorded. A little bit about me. I'm the co-founder here of TheoTrade. I've been trading now, actually, this is going to be my 20th year of trading. I started trading in the late 90s for a little unknown startup firm. And then I was invited shortly thereafter to another unknown startup firm, and that one was actually called thinkorswim. I progressed along with thinkorswim. I ran thinkorswim's education division for a number of years. In 2007, we became a public company. We hit the oh-so-coveted unicorn status. A few years thereafter, in 2009, excuse me, we were acquired by none other than TD Ameritrade. So I went on to run the education for what was at the time 7 million clients for TD Ameritrade. I ran that from 2010, until 2015. And that was pretty enlightening experience. Not just, education for 7 million clients, but really the ability to look at what 7 million people do on a day-to-day basis, which I'll actually allude to a number of times during tonight's presentation. I've done a couple of the CNBC tours. I have to tell you, in terms of like CNBC, and you get pitted against different people. One's a long, one's a short. I was the short, he was the long, but I just, this is one I actually fully appreciate, because if you're going to get pitted against somebody and you're going to be right, this is the guy you want to get pitted against. I mean, it's everybody's, love-hate relationship there with Mr. Wonderful. A little bit about TheoTrade. So if you're brand new, you have absolutely no idea what a TheoTrade even is. We specialize in education for stocks, options, futures contract. Everybody here, and when I say everybody, all of the instructors here are professional traders, okay? Everybody has a minimum of 15 years of experience. So we don't have any, there's a young guy that came on and he's had 3 years. Absolutely not. Everybody here has a minimum of 15 years industry experience. A couple of them actually have a couple of different decades in the marketplace. One of them, which I'll discuss momentarily, he's 43 years in the business. One of the first things I want to mention here is we designed this firm to help you mitigate risks in the market, and really learning skill sets is going to last a lifetime. And what I'm going to discuss tonight is really one of our primary strategies for risk management. The next thing I always like to cover is who is TheoTrade. At TheoTrade, we have Doc Severson, Jeff Bierman, Steve Slim Miller, Tony Rago. We've actually also got now Corey Rosenblum. Apparently he didn't make this slide just yet. So we have 5 full-time instructors plus myself. Again, I put a lot of stock, if you will, into some of the veterans that we have over here. Doc is one of our technical specials, trade stocks and options. Jeff Bierman. Jeff actually worked with me at TD Ameritrade. Actually, Jeff worked with me at TD Ameritrade for 7 years side by side, both thinkorswim and TD Ameritrade. And he actually held the position of the chief market technician for all of TD Ameritrade, which is a pretty highly coveted position. Steve Miller. Steve actually started on the options floor, 1973 when they founded the options floor in Chicago. Tony Rago is our NASDAQ intraday futures specialist. So that's a little bit about that. I'd like to let everybody know this isn't a one-man show, and that's important to me. What you're going to learn in this presentation, and again, I put huge stress into this. So I'm just going to take you through a couple of the major bullets in here. How to position your portfolio with the right trade logic and principles of building a trade. It's one of the first things I'm going to talk about is what I term principles of building a trade. That's how we approach everything here at TheoTrade. Okay. And it, hopefully changes the way that you view markets. How to replace stock with defined risk option strategies. Now, let's talk about that for just a brief moment. I've talked about this a lot. How to play stock, how to replace with defined risk option strategies. Now more than ever, I think that that's fairly imperative. New ways of looking at risk. Obviously, how to make friends with direction. Well, we're going to talk a bit about direction here momentarily, and you're going to learn one really key component over here that we call direction must eventually bow to. Then we're going to have quite an in-depth conversation about probabilities in your trading. So you're not going to be using, MACDs and Fibonacci's, I promise. We're not even going to look really at a chart tonight. In fact, you won't see one chart this evening. Is that okay? So I'm not going to talk about a MACD, a Fibonacci, a Bollinger Band, and I'm going to show you why here. And then we're going to get into a recipe of a strategy. And you're going to hear that term recipe, or what I term criteria, extensively tonight. We call the Inout spread. The Inout spread, unequivocally is the bread and butter strategy that we tend to use on a day-to-day basis to help mitigate risk, substantiate returns. It's going to build a lot of confidence. If you're a beginner, fantastic. If you're experienced, even better. Okay? You're going to be able to follow a lot of this recipe. Now, before I get head on into this, some of the stuff I'm going to talk tonight, it's a little bit hardcore, right? Are you willing to put forth the effort? And I think that that's a fair question. I've been on the education side of the business when we started thinkorswim. People were excited about learning. Today, and again, this is going back, 15, 16 years ago, people are incredibly excited about learning about markets. Today, everybody seems to want, they hop on TheoTrade and they're like, does this thing have red and green flashing arrows that's going to make me some money? And I get to the point where I just, I start throwing stuff at the computer monitor. It's a good thing I'm not doing this live. I start throwing stuff at the computer monitor because I'm like, listen to me. You want to learn this business, okay? This stuff ain't instant coffee and instant tea. This is a skill set. It's based on statistical data, okay? And the following course material, it can be a little bit demanding to learn. Now, you're not going to exactly have to be a rocket scientist over here, but this is not going to be some chart patterns, some trade setups, some red and green flashing arrows, because I got to tell you, I've been in this business long enough. Do you think that saw this marketplace about to sell off? I mean, really, in the last 48 hours, if you're still into chart patterns and trade setups and stuff, hopefully the last 48 hours, wake up. This marketplace is run by algorithms. You want to learn this business, you're going to have to put forth some effort. This stuff is a skill set. And what we're about to involve, you in tonight, it's trade logic, it's strategy, and it's probabilities in trading. And that's what you're going to find out really matters. Risk and success. How you handle your risk is directly correlated to your success in the markets. I have to tell you, I do a lot of different presentations. I've spoken literally all over the world. This same slide, I will use time and again, okay? The bottom line that I want to start this presentation with, too much risk, you're going to panic, you're going to close positions continuously at the worst possible time. But the irony is at least people are consistent with your panic. By the way, notice it's the Mac. It's all about the Mac throwing up. And by the way, if you don't know what this looks like, all right, if you've ever felt like this, then you've traded. If you've never felt like this before, you really haven't put on enough positions just yet. And I hope that this resonates with many people in here, for better or for worse. Again, you're here tonight to obviously learn something. So people panic, and they panic at the worst possible times. And I'm going to actually get into that right here, right now. What I've learned in this business after 15 years in the brokerage industry, okay, first and foremost, the brokerage industry allows us to look at hundreds of thousands of accounts. Legitimately, it's millions of accounts, okay? I've seen what works and what doesn't. One of the things that many people are not familiar with, your brokerage firm, if they're smart, they study you. They study trading habits. They don't study you. They're like, hey, John, I'm looking at your account. That's not what we're talking about. Like, I don't have time to go look at 100,000 accounts, but I do, and I did at TD Ameritrade, have the ability to run different studies on hundreds of thousands of accounts. And what you can actually zero in on, and we could ask specific questions. And by the way, we had a group. We used to call this group at TD Ameritrade the nerdery. What was the nerdery? It's a bunch of statisticians and actuaries. You could ask them any question you want. Who makes money in options? Who does this? How many people use vertical spreads? What is shocking, okay? What works and what doesn't, but what doesn't gets repeated over and over again. Today, we're going to discuss a really piece of core logic that has worked consistently over time. And I'm telling you, this particular presentation is the one that is based on more of the research that I did on hundreds of thousands of accounts, more than any other presentation that I've ever put forth. Theory, trade, logic. First of all, probabilities are law in the markets. You're not going to beat probabilities, okay? The next thing, one trade, good or bad, does not define you as a trader. Remember that. That basically means trading's got to go beyond one trade or one idea. It's about a number of occurrences. It's about thousands of occurrences. And you have to have, if you want to beat the markets, you have to have the right logic and be consistent over time. Remember, this is a lifelong skill, okay? No one learns it overnight. Go easy on yourself in here. But I want to reiterate this, that one of the things that we'll hammer on this evening, okay? If one trade, good or bad, right, hurts you, then you're too big in that trade. Just keep that in the back of your mind, because now with this theory, trade, and logic, we're going to move forward in terms of principles of building a trade. What I'm actually going to show you is, again, what we call trade logic, capital allocation, and directional bias. This is how we approach the entire marketplace, okay? What does that even mean? When I say we're going to approach the marketplace, I'm going to ask a fair question and I want answers. Listen, people are going to be listening to this on a recording. There's almost 1,000 people on live right now, but people are going to listen to this on a recording. Hey, answer out loud, write it down. I don't care. But for those of you that are live with me right now, literally, answer the question. What's the first thing that you look at? What's the first thing you look at, right, when you want to build a trade? And I want you to think about that for a second. Feel free to chat it in. What's the first thing you guys look at when you're going to build a trade? All right. Hey, at least you guys are honest. All right. Direction, chart, trend, trade direction, movement. All right. Direction. Oh, I like it. Pete actually said risk. A couple of people with risk. So I'm going to throw a little bit of a curveball at you to begin with. When we look at a trade, in any trade you're going to build, we actually place the trade logic first, capital allocation second, and bias third. Let me show you why. Trade logic, place, strategy, and trade logic first, okay? Listen, the vast majority of people involved in the markets are infatuated with market direction. They attempt to predict the next move a stock is going to make. It's going up, it's going down, it's going up, it's so down, okay? I want you to realize, though, that everything you guys are bombarded with, all right, everything you're bombarded with has everything to do with prediction. I have a MACD of Fibonacci. If you mixed a MACD and Fibonacci, you'd have a MACD Bollinger Band. I mean, I poke fun at the stuff. I'm not totally anti-charts, but I poke fun at the stuff. But you're bombarded with it. Everything from CNBC to every news media out there. It's ridiculous. Okay? But I want you to step back from this for a second. I want you to ask yourself, do you think that a trading firm, let's talk about, I had a bit of a career. Okay, I had a bit of a career in Chicago, and I worked for a trading firm out there. And when you walk into a trading firm, the first thing they talk about when you walk into a trading firm, by the way, when I walked into a trading firm, I was 22 years old, 3 weeks out of college, had no degree. I didn't have a degree in anything to do with finance. To be fair, though, I did grow up around traders. To be fair, that's how I ended up there. However, first thing they do is they put you in a class just like this, and the class is about gaming theory, and it's all about probabilities. And that always resonates with me because every single derivatives firm on the planet places trade logic first. And what do they teach clients first? If 3 arrows are up, you should buy. Why does that even make any sense? The right strategy, you got to put it first. You have to have a strategy, because if you don't have the right strategy, forget it. It doesn't matter if you're right. And I'm going to ask that question again. Have you ever been right and not made money. Oh, I got stopped out. Oh, I was right, but there just wasn't enough time. I was so right that I was wrong. I mean, you have to have the right strategy. And that's what people forget. That's what trade logic really is. Next, capital allocation. Why is capital allocation important? Oh, I don't know, because if you're too big, you're never going to be able to hold a position long enough. Right? Easy enough. Capital allocation does take precedence over being right. I don't care if you're right. You can't hold a position long enough to be right. Promise you. Okay? Come on, admit it, people. How many people got stopped out? Okay? How many people got stopped out in the last 48 hours and something? Okay? Let's not even use the word stop right now. How many people freaked out in the last 48 hours? See, that's why I like talking about this stuff, because when you talk about it when markets are kind of boring like they have been over the last 18 months, nobody gives a crap. Well, tonight, now you care. Okay? Capital allocation is actually more important than being right. Anybody tells you otherwise, they've never been in the extreme. They don't know what the hell they're talking about. The extreme. What's the extreme? I would say yesterday afternoon. You know, if you looked at the markets yesterday afternoon, you were watching it while the market was open, you felt the fear. You looked at it and said, oh, beep. Think about it for a second. Now, directional bias. I'm not anti-charts. Although I have been called an anti-chartite. I am a little bit of like an anti-chartite, all right? Directional bias plays a huge role. But where you think a stock might go, the market doesn't always agree with your sentiments. So being right directionally, it can't define you as an investor. It can't define you as a trader because you ain't going to be right often enough, right? Our work eye has to be duration over direction. How and where you allocate capital can not only define losses, but it can be the defining factor in your overall success or failure in the markets. Our work eye, again, duration over direction. That's something that's been used, by the way, the term duration over direction, that's been used in the options market since the late 1970s. There was actually an individual down on the floor to remain unnamed. He's still alive and a close friend, but they used to scream out, duration over direction. And it's just a saying on the floor. And you think about those things. When you guys are approaching the market, I'll back up for a second. You think about how you approach the market, because that's what we're actually going to get into a little bit tonight. We're going to get more into strategy and logic. We'll talk about direction at a later time. Now, you want to be right or you want to be happy? I love that phrase because my wife says it, a lot, and she really does. Like, can't make that crap up. And apparently I have not applied this to my marriage, but the logic seems to work beautifully in trading. I always take the stance. You don't necessarily have to be right to make money, and I'm going to show you that. Why? Experience in watching order flow for decades has taught us invaluable lessons. Here, you ever been stopped out of a trade or bailed out of a position only to see the markets turn around shortly thereafter? Okay, we call that puking your position. Think about the Apple computer when we started. The person barfing up. Okay, this is actually what happened to people probably in the last 48 hours. Everybody panicked on Monday, but Tuesday it's okay. But wait, there's 3 more days to this week. Think about this. Let's get into it right now. Okay, let's start talking about core strategy and trade logic. So I'm going to introduce you to a real world strategy that you can use and start it tomorrow. Like, the stuff that I'm going to talk about tonight, this is one thing. If you're going to spend an hour with me, I want to make this stuff applicable tomorrow. Like, otherwise, you're like, some of this you're going to be able to use tomorrow, okay? But first, we're going to hammer out risk versus reward. And this is imperative because, when I was talking a moment ago, I sat down at a trading firm as a young 22-year-old. I really was. I was 22. I was 3 weeks out of college. It was summer of 98. It was actually the same summer that long-term capital management fell. Anyway, one of the first things they talked about was theory, was gaming logic, but they also talked about risk reward. The example I'm going to give you right now, it is directly from a trade instructor that ran a major derivatives firm. So when we first learned about the markets and trading, we're often exposed to the ideas of risk reward. One of the first things people always say, risk 1 to make 2. That's the common strategic entrance to the marketplace. Now think about it. It sounds pretty simple, right? Risk one to make two, risk one to make two. And this is ingrained in you. But have you ever looked at risk one to be able to make two? Have you ever looked at this from a probability standpoint? I think it's a fair question. So let's debunk it. Debunking risk versus reward. So let's say, and by the way, I'm going to give you an example, and then I'm going to give you a real example. I'm going to give you an example just like, sketched out over here, and then I'm going to give you a real example. So you go out and you're going to buy a stock. What's the name of the stock? It's stock. By the way, I call every stock stock. It doesn't really matter. It's a $30 stock. Are there even any $30 stocks left? I have to laugh when I say that. No, Don, every stock is $1,000 now. There are no $30 stocks. Unless, of course, your Snapchat, which is about 17 after hours. But hey, if you go out and buy a stock, you buy the stock at 30. We're going to set a stop order. Let's just say we set a stop order because this is prototypical stuff, right? So you buy the stock at 30, you set the stop at 29. What can you lose? $1. Then you set a target price of 32. What can you make? 2. Prototypical risk one to make 2, right? Now, okay, what is going to happen in this trade? I have an answer. Probabilities in your trading. What's more likely? What is a more likely occurrence? Now, I want you to think, oh, you know what? Let's talk about a chart. If you're going to look at a chart, what does a stock do? A stock goes up, a stock goes down, a stock goes up, a stock goes down. Lately, the stocks just go up and then they fall down. That's, by the way, this is my interpretation of 2018. We went up and then we went straight down. And now we're somewhere over here. We might go up unless, of course, we go down. Do you like that? All I'm getting to, this is the best chart I've ever drawn. All I'm getting to here is a very, very simple idea. Okay? So what's the simple idea? I don't know. What's your risk? $1. What's the target price? Well, it's got to go up $2. From a probability standpoint, what's going to happen first? Like, why doesn't anybody ever look at this crap? Nobody ever points out. So here's the stock at 30. It can go down to 29. It can go up to 31. For you to make money, though, it has to go up to 32. I'm making a little binomial tree. What is more likely to happen? Hit 29 or hit 32? You know what somebody, the other day, I was talking about this exact example, and somebody actually said, well, about the Fibonacci, my 618, and I almost threw something. I might have thrown something across the room. The Fibonacci's at the 618 over there. Yeah, but you know what? After you do 100 occurrences, what's more likely? The more likely event is hitting 29 before hitting 32. It's just simple math. Look, you have a distribution curve. You have to go up 2 to make money, down 1. The probability of going down 1 is extensively higher than going up 2. That's it. That's as cut and dry as it possibly gets. Now, I'm going to give you definitive probabilities here momentarily. Okay? So, options or probabilities. Okay. I said the O word, options. Some people, oh no, you may have never looked at or even traded an options market. However, you aware options are based on probabilities. Options can help us in determining the viability and practicality of any given strategy. How, you ask? Let's look at what the probabilities are in the aforementioned risk one to make 2 trading setup. And let's see if this is viable over the duration. Okay? Here's a real example. By the way, I have a fun one. This is a Starbucks example. And you know why I left the Starbucks example in here? Because the stock is still at $56 basically, but let me show you and let me take you through this. Okay? This gets a little bit confusing in context, and I'm going to clean this up. So what we're looking at right now happens to be Starbucks at $56. Okay, just follow where I'm at. So Starbucks is at $56. What's the probability of going to 58 versus the probability of going to 55? Okay, what am I doing? This is a risk one to be able to make 2. It's the perfect scenario. By the way, I waited this day for Starbucks to close right on 56. I'm like, come on, 56, big money, big money, big money, no whammies, 56. And I took the screenshot. We're looking at an option market that is 38 days out. Why 38 days? I don't know. I just picked right around a month because I figured a month was easy. And we're looking at the options market. Why are we looking at the options market? Because it's based on probabilities, right? So the options market's based on probabilities. And there's a calculation called probability of touching. Now, if you don't have that on your software, don't worry about it. You don't need it. You don't need it because I can show you how to calculate probability of touching on any trading application that has options listed on it, okay? What probability of touching does is it says, what's the probability anytime in the next, 38 days of touching, okay, or exceeding a particular level. Now, this stuff, again, it gets confusing if you've never seen it before, but all I'm saying is the probability of touching 55, okay, is almost 70%. The probability of touching 58, okay, is 45%. Time out. You better think about that for a second. If you do this trade, you do a trade where you go out and you buy Starbucks, at $56. If you buy it at $56, what do you have? Just forget about even the profit. You have almost a 70% chance of getting stopped out. Now, let me ask you a fair question. If somebody showed you this, hey, Don, you have a 70% chance of getting stopped out, would you do that trade? Would you do that trade? I think it's a fair question. Okay? The probabilities, they don't lie. This isn't, this is a screenshot taken of a live market condition. You can do this all day long. And this happens to be the thinkorswim platform. You do not need it. You can use IB. You can use any trading application you want. There's calculations that suffice for probability of touching. This is where you have to decide if this stuff is going to be right for you. You have a 70% chance getting of touch done here. Now, if you set a stop order at 55, you're going to get stopped out 70% of the time. Risk reward revealed. In the aforementioned Starbucks example, the probability of the stop price getting hit at 55 is 69%. The probability of hitting the target price is 45%. The risk one to make two scenario is a setup for a low probability disaster. You're just going to get stopped out. Okay, what are you going to do? You're just going to keep flushing capital down the toilet. People don't realize that a risk one to be able to make two scenario is an incredibly low probability disaster, and it actually bleeds people dry. It literally starts bleeding the account because 70% of the time you're getting stopped out. You start to hit like this futility thing. You think, I'm the crappiest trader in the world. You might not be. You might be a decent trader, but your logic is completely screwed up. Okay? Positioning your portfolio with the right trade logic. Let's get down and dirty. How do you position yourself most effectively without exposing yourself to drastic risks or a low probability? Okay? Would you be interested in a strategy that, number one, we overcome the high probability being stopped out? Okay? We're going to get into a strategy, overcome being stopped out. Check. Defines your risk. Check. You know what defines your risk means? It means if the market tanks, your risk is defined. You're going to know what you can lose. How about we also give it a high probability of success? Check. Limits overall capital exposure. Now, this just sounds like defines your risk, but it's not. Capital exposure means you ain't got to buy the stock, and you never need to buy the stock. I put that as the fifth bullet point just for fun. All of these are embedded in one strategy. That's called the in-out spread. So we're going to talk about in-out spreads. They're designed to limit exposure, maximize potential with minimal movement in the underlying. In-out spreads are option trades. I like saying option. Some people, he said the O word. I told you, you're going to have to learn a little bit, okay? Fear not options. As option spreads, they allow you to limit risks without the use of stop orders while providing considerable upside potential. Now, let's get to it. In-out spreads explained, okay? So I'm going to go in now and I'm going to show you a little bit about the in-out spread. Why? Because we're going to teach you it. Then we're actually going to go into the live market, do a couple of examples, okay? What stock? Huh? Anybody? What stock do you want to make this? Oh, come on, please. Tell me what stock. Tell me what stock. What stock do you want to make this? We don't have to make it stock. We can make it your stock. Oh, Costco. Hey, Costco is a sore point for me, okay? Look at this. Apple, 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 Apple. One of the later examples is Apple. All right. Oh my gosh. This is an Apple kind of crew. Oh, Tesla. Oh, I like it. Tesla. Do you have a death wish? By the way, did you see what they did today with Tesla? They took a Tesla Roadster and they shot it into space in a SpaceX rocket. Time out a second. Why did they do that? It's a nice car. You can't drive a car in space. Just throwing that out there for your consumption. Anyway, okay, you know what? I've actually got examples in almost all of these. Fantastic. All right, I'll tell you what, I'll make this one easy to begin with. I'm going to say that this happens to be, and again, we're just going to start easy on you, okay? Let's make it a $200 stock, okay? It's a $200 stock. Now, obviously, you could go out and you could buy this stock. You could go out and you could buy the stock for $200. And did they put a dummy in the seat of the driver's seat of the car? I don't know if that's true or not, but it's funny. It sounds like it. Anyway, it's a stock. It's 200. By the way, I have examples on a ton of these, so I'm going to get to them, like Apple, Amazon, a couple of them. I've got examples already configured in here. So this is a stock, and the stock is basically trading at 200. If you go out and buy the stock, obviously you have risk. Like this $200 stock, just in the last 48 hours, dipped down. Let's say it got all the way to like 185. It rallied back up today, probably halfway. It's probably somewhere around like 192. I mean, that's reality. That's reality. That's just a $200 stock that just lost $15, bounced back. Lots of people are going to get clipped. They're going to get stopped out, right? And what was your inclination in the stock was just to make a small return, okay? Maybe $5 or $10 to the upside. And that's where a lot of people get to. So enter this in-out spread. All I'm going to do with the in-out spread is I'm going to mitigate our risk. If you've never heard the term like mitigation, risk mitigation with this $200 stock, okay, well, I'm going to go out and I'm going to buy. Okay, what am I going to buy? I'm going to buy an option in this particular case. Now, anytime you buy an option, options are good for a period of time. Okay, options are good a period of time. We call that expiration. Right now, we could say this option is good for 1 month. We'll actually learn with this strategy that time does not matter a tremendous amount. Now, this could be a $200 product, something like the spiders. And again, I'm going to make this first example very easy to interpret. So kind of bear with me. We're going to go out and we're going to buy, in this example, okay, let's make it a 199 call. Now, if this were 199 call, this would have to be something like the SPY or the QQQ. All right, it would probably be an index type product, which is okay. We're going to buy a 199 call, and that 199 call is good for a month. Now, you're going to pay something for this 199 call. What are we going to pay for it? All right, well, let's start, as I said, let's make it a little easy. Let's make this thing $2.50, okay? That's going to cost us $2.50. So what do I have? I have the right to buy the stock where? Well, I have the right to buy the stock at 199. How much should I pay for that right? $2.50. Okay, so $199 call. What's the $199 call give the right to do? It gives you the right to buy the stock at $199. Where do you need the stock? Well, you need the stock to go up fast, up huge, up somewhere. Okay, but at the same time that I'm going to buy a $199 call. By the way, buying the $199 call gives me the right to buy the stock at $199. It does not obligate me to buy the stock at $199. At the exact same time, we're also going to sell. Okay, we're going to sell. What are we going to sell? In this case, a 201 call. Now, a 201 call, you're like, oh, I'm buying. I have the right to buy the stock at 199, but someone has the right to take stock from me at 201. So I can buy the stock at 199? Yes. But I have to give it to somebody else at 201? Yes. What's the most you can make? What's the most you can make? Forget about what we're selling the call for right now. What's the most you can make in this spread? If I can buy the stock at 199, but I have to give somebody else stock at 201, what's the most I can make? All right. Well, I can only make $2. I can only possibly make $2. Now, what did I sell this thing for? I'm going to sell it in this case for right around $1.50. Okay. So what did I do? The buy side, the buy of the 199 call, and then there's a sale, okay, of the 201 call. The buy is actually done for $2.50. Okay, that's going to be a debit. The sale of the call is going to be done for $1.50. The net debit, yes, this is a debit spread, is $1. Now, what's the most I could possibly lose in the trade? $1. What's the most I can possibly make in the trade? $2. You're like, why would I want to do this? Why would I want to risk a buck? Oh, I want to get into this because why would I want to risk $1 to be able to make $1? Okay, splice this down the middle. Why would I want to risk $1 to be able to make $1? Okay, because right here, this is what we bought. Right here, this is what we sold. Most we can make is $2. I'm going to risk $1 to be able to make $1. Why is that okay? Because this is the part where I get into strategy and I get into logic. People don't get it. They don't get it because they're not trained, okay, on gaming theory. They're not trained to look at strategy and logic. They're trained to go, Don, is this stock going up? And that crap doesn't matter in this example. And I'm going to tell you why. Okay? I want you to think about 1 month from now. What can happen to the stock in a month? The stock in a month, I mean, this thing can go all the way down to 185. Blah, you're throwing up in the street, but it can rally back up. See, here's the cool part. You have the next month for the stock to go up. But if the stock goes down, the most hit you could take is $1. If the stock goes up, the most you could possibly make is $1. Do you have the next month? The stock could oscillate all the way down here. The market could crash. Most you can lose is $1. Yep, and in the same month, the market could come right back up and you could be profitable. Think about this from a probability standpoint. You don't get stopped out. Why? Because your max risk is $1. You're not going to get stopped out. Who cares? You lose $1. You lose $1. Amen. I am going to lose $1? I don't want to lose $1. Okay, hold the position. You know, if the stock sells off really big, you still have a great probability of it coming back. This strategy buys you duration. It buys you time. It buys you time to be wrong. It buys you time to be right. You'll laugh. You'll cry. But you ain't going to get stopped out. It will keep you in the trade. And what you'll learn about Inout spreads, time, okay, doesn't matter. You could actually buy the spread for a month or 2 months or 3 months, and it won't cost you more. It will not cost you more. It gives you duration in a spread. I know this slide is a mess, okay? But now I'm going to show it to you for real. The Inout spreads, Starbucks example. Let's continue our Starbucks example. However, rather than use stock, we're going to use Inout spreads. We ain't using no stinking stop order. Rather than buying stock at 56, we're going to use a spread trade to limit risks and provide a high probability without the use of stops. Frappuccino. Now, here is a real example, okay, which I will show you here momentarily, just like I set it up. Here's Starbucks at 56. We will not buy the stock. We're going to buy a 55 call. We're going to sell a 57 call. Let me ask this question. If you buy the stock at 55, you have the right to buy the stock at 55. Somebody's going to take that stock from you at 57. Now, do I ever have to own the stock? No, I never have to own the stock. I could just trade the options. And people are like, what if I'm assigned? Well, okay. Somebody says, I'm taking stock from you at 57. You can say, well, I can take stock from somebody else at 55. Welcome to the market. What do you make? Well, if you could buy the stock at 55 and somebody else takes stock from you at 57, the last time I looked, you're still making $2, of which you paid $1 up front. This strategy just bought you duration. It's a wonderful, wonderful world. The stock can go down. It can barf its guts out. The stock can go up. Okay, as long as that stock gets, decent above 57, yeah, beautiful. Why? Because you're going to make $2 in the trade. This stuff is critical. Like, it's such an easy idea, but you have to understand the trade logic behind it. Now, this is the real trade. Okay, as I said, we don't come in here with like fictitious examples. We come in here, this is a trade. Now, here's even better. This is a screenshot that I actually took, a few weeks ago. Why did I do it? Because it was a profitable trade. I took the screenshot actually back in December. It was a profitable trade. I wanted to show you. Actually, I bought the 55, 57 Starbucks, okay? And I did it for $1, which is my maximum risk. So I went out there and I did the trade. I bought the 55s, I sold the 57s, and did it for $1. What happened to the trade? Now, if you want, go look at a chart. The stock exploded higher in early January, okay, in more than enough time for me to be able to make money. Oh, and then here's the great part. So the stock got all the way up. I could show you a chart, but, I'll be an anti-chartist. Stock got all the way up to about 62 and then tanked. Tanked on earnings, right? Apparently, tea is not their thing. But people are still willing to pay $5 for a cup of coffee, of which I probably had too much of today. So this Starbucks example, it's real. Now, I'm not telling you you're going to be right, but I'm telling you if you use the right strategy coupled with the right entrance criteria, right? You need to know how far out in time to go. You need to know why the 55, 57. You need to know exactly when to exit it. Let's move on. Now, this was Starbucks. Somebody said, Apple. Okay, Apple. This is today. I actually took the screenshot a few minutes ago. So if you take a look at Apple. So Apple is trading right now at 163. I'm actually buying the 160, 165 spread. Now, this is a little bit different. This is not $2. If I have the right to buy the stock, listen, if I have the right to buy the stock at 160, you can buy the stock at 160. Somebody has the right to take stock from me at $5 higher. What's the most I can possibly make? This is a big boy spread. It's a $5 wide spread. Max risk in here is $2.50. Okay. Is this trade going to work? I don't know. Are you bullish right now? Are you feeling lucky? Because this one's here for you. That's there for the taking. I do not suggest you go out and buy this thing at the open tomorrow. Okay. This is opportunistic right now. Apple's been beaten down. This is a bullish trade on Apple. But I want to hammer to you. What's the most important thing in the trade? The logic. What's the most important thing in the trade is to know the exact options that you need to buy and sell to be able to do this trade. Okay? You need to know how to set these trades up perfectly. And that's where people kind of screw this up. It is a very easy, logical trade. But you have to have the nuts and bolts. You got to have a checklist to be able to get in and to get out of this thing. Now, that's Apple. Do we like it? Okay? Do we like it? By the way, the probability of touching in here, I could show you that all day long. But we're a little bit low on time. The probability of touching, okay, even up to the 170 level is about 60%. It's high. There's a huge probability of success in a lot of these trades. That's why we call them high probability in-out spreads. Now, Amazon. Let's show you Amazon. So Amazon is a $1,442 behemoth. If you trade Amazon, you pretty much trade the options. Okay, you kind of have to. The in-out spread, unequivocally, is the cleanest. Listen, the in-out spread is the cleanest, it's the fastest, the safest way to be able to trade something like Amazon. This is a $5 wide spread in Amazon. But here's the differential. This trade, this is done with what? Puts. This one's bearish. I just wanted to throw a bearish example. Why? Because I don't like Amazon. All right? Why? I don't have a good reason. But that's okay. You know what? I don't like it because it goes up every single day. But I also wanted to show a bearish example over here. I think that's a fair reason. I don't like it. I don't have to like it. Okay? But, it's Jeff Bezos. What's not to love? Anyway, here's a $5 wide spread. I buy the 1445, sell the 1440. Right? Again, it's puts. It's puts. I have the right to sell the stock at 45? Somebody has the right to put me stock at 40. The most I can make in here is $5. What's the max risk? 230. All I wanted to show you at a glance, you name a stock, and you guys named them all, okay? You could do this on all of those underlyings, whether it's IBM, whether it's NVIDIA, whether it's Amazon. Somebody said Teva Pharmaceuticals, okay, whether it's Google. Costco, I've done tons of these in Costco. Caterpillar, oh, there's a stock I love to hate. I have to tell you right now, I am in an in-out spread in Caterpillar. It's gold, Jerry, gold. Microsoft, been there, done that. Facebook, Netflix, all of these, okay, are scream out in-out spread. Okay, Tesla, especially Tesla, screams out, again, in-out spread. You can do these in, around currency products. You name it. Commodity products. You want to get into gold. Gold's going to break, to 1,500. Use an in-out spread. Here's a couple live examples. These are trades that I have done. This is an Intel spread. Now, the Intel spread that I did, I'm going to show you, again, the exact date. The inception of this trade would happen to be November 30th. Okay, I went out and bought the vertical spread. I bought it for 97 cents. Okay, I turned around on December 5th. I sold the spread for $1.50. Not always going to maximize. Okay, there's actually a key component in understanding the in-out spread. These are real trades. This is the exact time of execution. I am in mountain time. I live in Scottsdale, Arizona. Why? Because Chicago, the weather sucks in February. Yes. Okay, it does in Canada and Detroit and everywhere else, like in, the whole Midwest. Not good at this time of the year. This is in mountain time, though. Each of these trades has been placed. This is just an Intel in-out spread that I did. Pretty straightforward. This is a bearish trade. Okay, Intel actually broke down. Next trade, Walmart. Now I'm going to show you a trade. I didn't do that well. You know why I brought up the Walmart trade? Look carefully at the date. I put this trade on, okay? I put this trade on right in the beginning of the year. In the beginning of the year, I put on a bearish trade in Walmart. Now, okay, mind you, I paid 91 cents for it. And I did this one in quite some size, okay? Look at the date today. I got, how do I say this very nicely, the heck out of Walmart. And I actually did it, okay? I was very proud of this one. I made 10 cents on it. You go look at a chart on Walmart. Walmart just the other day was trading 108. I had the 198 put spread. It was like nosebleed. Yesterday, Walmart came all the way down into the 98 region. This morning, the market started bouncing. I'm like, get out, get out. I'm like waving the white flag, get me out of it. I can't believe I actually made 10 cents on a strategy that blew up in my face. I don't mind showing you a crappy trade. This is a crappy trade that I pulled out the impossible. Okay? It was dead, and I still pulled it out. You want to know why? Duration over direction. Duration over direction. Again, another bearish trade. Next, PayPal. Another bearish trade in PayPal. PayPal, this is not exactly a home run. This is actually in November to, again, December 4th. And I went out and I paid $1.23. I sold it for what? $1.84. So that's a little bit of a PayPal spread. Last but not least, in this one, this was a bit of a home run too. Take a look at the date on here. I put this on XHB. By the way, this is one that I did on the nightly videos. I did the trade in the nightly videos. I showed everybody this spread. I showed everybody the Starbucks spread. I showed everybody, okay, the PayPal spread. Every one of these, okay, I showed in some video. And did you do it? Did you do it? Because this one, the XHB. Why did I do the XHB? It's the Home Builders ETF. It's the Home Builders ETF. Why? Because interest rates were flying up, right? Interest rates were flying higher, so I got bearish in the home builders. I bought the spread for 81 cents. I sold it for $1.64. It's not bad for a return. Again, this one happened to be closed. Take a look. Okay, that one got closed yesterday. And I'm fairly proud of that one. And I'm going to tell you why I'm proud of that one. I had a tough time trading yesterday because it was just wild out there, but I still was able to execute that spread. This is the kind of stuff that you need to learn. Characteristics of in-out spreads. The attributes of these high probability in-out spreads are undeniable. You never have to buy the stock. You define your risk. Your risk is limited to precisely your comfort level. We'll tell you, do you want to do one contract? Do you want to be 5 contracts? Define it, tweak it. Okay? You don't use a stop order because you're never going to get stopped out. You can vary time frames and not pay more. The probability of profit is high. Like the probability of touching in these things is huge. It's the perfect spread to reduce risk of a stock portfolio. Why? Because you don't have to own the stock. You do not have to own the stock. It's also an excellent tool for those looking to build smaller accounts. Okay? You need to learn this stuff. Now, building the in-out spread. Do not let options intimidate you. Spread below, it's being done for $1 debit. But like any options, when it comes to options, I always think of options They're the power tools of a marketplace, okay? And when you look at a power tool, I mean, you're going to go out and I use the same analogy all the time, but if you're going to go out and use a power tool to build a house, or you're going to use a hand tool to build a house. I mean, if you think about it, you go out and you're actually hammering nails by hand with a regular hammer, it's going to take you probably 20 years to be able to build a house. But if you use a nail gun's going to be the quickest, the fastest, the safest way to get where you want to go. You're going to be able to build that house. But if you don't know how to use a nail gun, probably going to end up with your hand nailed to part of the house. The same exact true. It's so true of options. And that's why options get kind of a bad rap. I mean, people do crazy stuff like they trade the UVXY. You know, they have no clue what they're even trading. They trade the XIV. The XIV is forever done. Okay? It's done. The XIV, gone. Credit Suisse canceled it. They're returning whatever money is left in there. If you used a spread in there, did you know that the Option Clearing Corp backed all the volatility spreads the last couple of days? Use this spread correctly. It's going to be, again, the quickest, the fastest, the safest way to get where you want to go in the marketplace. Used incorrectly, you're going to cut off a couple of fingers, probably nail your hand pretty hard. Fear not the in-out spread. If you don't know options or have limited, experience, we can teach you that. We can show you how and when to place in-out spreads in a matter of a few hours. We got detailed recipes for this. Every strategy, including in-out spread. I look at trading when I'm actually building different courses and course materials. I look at it, everything as recipes. You don't bake cakes without recipes. I mean, listen, if you've baked a cake 50 times, you probably don't really have to look at the recipe. But you peek, you're like, that's a quarter cup of what? Right? Little vanilla extract for you, a little bit for the cake. You have to have a recipe. Why do people trade without one? I mean, that's where you get yourself into trouble, because you kind of like, I'm going to make up the rules as I go along. Come on. Anybody ever done that? What's the rule? The rule is I will make it up. Why doesn't everybody do this? Here is what you need to know. What stocks to trade this on? It's pretty easy. I mean, I just went through a bunch of them. Okay, what stocks to trade this on? Determine whether you're bullish or bearish. Expiration, strike selection, position sizing, that's allocation. Correct probability for the trade. Oh, everybody wants to know probability of touching. How do you execute the trade? When do I exit? What do I do in a losing position? That's what we do here at TheoTrade. Criteria. It's what we do. We build the recipe for you. Trading is really about answering the what ifs. What might be a good candidate? Okay, the correct options expiration, capital, strike options you buy, strike options you sell. I mean, again, we got the answer to that. We'll give you the right probability. We'll give you the number of contracts to trade for the account. We'll give you when to close it. What stock sells off big? What's the correct return for the strategy? Stock rallying massively. Can I fix a losing trade? We have the answers to all the trade-related questions, and we build definitive criteria and checklists. Like literally, we build a checklist. Step number 1, step number 2, all the variables you're going to encounter. That, the how, the when, the why, at what price. It's just the beginning of the variables. The secret's in the sauce. And the people they're going to go online again. I could read about spreads anywhere. You can. You can read about spreads anywhere. What you cannot read about, okay, is all the criteria. You got to follow the steps to be able to build the trade. And that's what everybody really needs to learn. We have a class coming up, the high probability in-out spread course. Now, I'm going to tell you, okay, this class has been legitimately 15 years in the making. I started doing a class on in-out spreads literally 15 years back was the first time I ever did a class on in-out spreads. It's been refined, okay, condensed, improved upon. I'm doing the class live this Saturday. I'm doing the class live. This is not recorded, okay? When I say it's not recorded, the class will be recorded, but you're not going to download. You're going to see the class live this Saturday, February 10th, 10 a.m. to 1 p.m. Eastern Time, okay? We start early. We get done early. I got little kids. The slide deck that includes the entry and exit criteria, it'll be available for download just prior to the class. You will have lifetime access to the on-demand recording. Yes, you'll be able to see the recording of the class as much as you want, but I am doing the class live this coming Saturday. I am very excited about it. It has been many years since I've actually taught an Inout spreads course. It is the bread and butter of what we do here at TheoTrade. And if you want to see what I would consider the single biggest logical class that we've ever built, this is it. The addition to the class, we are going to give you Options 101, Basics and Beyond. You'll have access to Options 201. You will have access to Options 301. On top of it, you're also going to have a 1-month access pass to TheoTrade. That's going to give you access to every coaching session we've ever done. The entire thing is $199. TheoTrade.com, okay, /in18. This is TheoTrade.com /in18. A little bit weird. Make sure that you get that address right. TheoTrade.com /in18. I'm not done because I want to explain a couple of things to you on here. By the way, this will qualify you for a reduced commission rate. Okay, if you're interested in what the reduced commission rate, please, by all means, you can ask in the chat room. The commission rate is good enough that we cannot mention it on any live broadcast. With the Inout, spreads course, and I'm telling you, you want to take this course on Saturday. With it, you have access to 1 month to everything, okay, that we're going to do inside of the next month. I'm going to get to that in just a moment because you get to trade with us for a month. You get access to the chat rooms. You get access to the coaching archives. When I say the coaching archives, see, people don't really realize, at TheoTrade, we've been around a while. If you go to the Start Here button, go to the Start Here, okay, you have a month of access to all of these. Preparing your trading day, okay? Order execution part 1, 2, and 3, crash course and option geeks, getting your risk under wraps, risk control and hedging ideas. Do you think that's important right now? I'm pretty sure this alone, that's an hour-long class. That's worth $199. What products to watch and why? Part 1, 2, and 3. This is just to get started. You'll also have access, and I'm going to show you under Member Home over here, you're also going to have access to every archive. You want to know a strategy, like name a strategy. I'm serious. Name a strategy. I'll type it in over here, okay? Like iron condors. Type in iron condors, hit enter. This is just searchable. Low probability iron condors, low probability iron condors. Okay, iron condors Q&A, iron up for you and me. It just goes on and on and on and on. Oh, there's even one from, iron up Q&A. It's great. There's even different strategies in there, around the iron condor. By the way, check this out. We're also here to help you. I'll come back to that in a moment. Before I get into everything that's included in here, I want to show you, this is the curriculum to be covered. This is the curriculum to be covered. Again, it's TheoTrade.com /in18. You have to type in IN18. So it means, TheoTrade.com /in18. It means the Inout spreads for 2018, but it's just in 18. This is the curriculum. You're going to learn to construct the spreads, okay? You're going to learn how to create consistent returns, okay? You're going to learn how to buy long duration options without paying more for time. It's define risk reward strategies. You're never going to lose sleep over your positions. You're going to learn the definitive criteria. You're also going to learn how to set and forget. Set and forget. If you've never actually heard that term, it means good till canceled orders, GTC orders, okay? You can do this with a $2,000 trading account. And people always turn around and they go, but my brokerage firm won't let me trade options. I'll help you there too. Okay? You could do this in a retirement account, minimal options experience, smaller accounts looking for upside potential. You do have to have $2,000 in the options account. That's the class. It is coming up this Saturday. So I know some people are like, I can't make it Saturday. It's on demand after Saturday. But I'm going to stress to you, I strongly urge you to be there live because that's where I get to answer questions. And I'm reading the chat right now, but I want to be able to answer questions to it. Now, TheoTrade 1 month access pass. The course includes a 1 month access pass. It's everything we will do for the next month. Daily coaching sessions, Okay? Stocks, options, and futures. There's a live trading chat room. We have live traders, and it's video streaming like this. You'll learn about intraday trades. You'll learn about Inout spreads. You'll learn about iron condors. You name it, we cover it. You're also going to get the instructor and coaching archives. That goes back over 2 years. The Start Here selection, I already showed you that. There's 22 videos to get you started right away. We're going to email trade ideas, and you're going to like this. Any TheoTrade proprietary indicators, we will give them to you. Okay, the TheoTrade proprietary indicators, like, what does that even mean? First of all, this is our chat room. This is what it looks like. Welcome to the TheoTrade. We're not broadcasting right now, but you can look back and actually see some of the chat that we do throughout the course of the day. What else do we have in here? Shared charts, scans, and studies. You're going to have access to all of these. These are all the proprietary studies. Do we have enough for you? This is like scans. This is my watch list. This is your trade setup. You name it, it's in here. You'll have access, okay, to the archives. Specifically, you'll have access to the coaching archive. Okay, you will have access to the coaching archive, and that is the daily sessions that we do that are educational in nature. Like every day is a class here at TheoTrade. Go right to this site right here. Let me actually pull it up again. It's theotrade.com/in18. The whole thing's $199. You know why we do this? Okay, we do it. We want people to learn this stuff, especially, like, again, you look back over the last 48 hours. The last 48 hours you're trading. Did it cost you more than $199? You got to ask yourself that question. If it cost you more than $199, okay, at the very least, come to the class to learn how to mitigate your risk. Like, control your risk, right? We're doing it this Saturday. Hey, listen, this class has been on the schedule for a while. And now more than ever, though, I really feel like people need to learn how to spread their risk. Do you really, again, do you want to go home, over a weekend and be long stock and just pray that nothing ultimately happens, or you're going to learn to use these spreads? I'm going to answer a couple of questions right now, and we'll move forward from there. Again, there's a lot of commissions questions in here. We are working with that. By the way, the primary negotiated rate we have is with TD Ameritrade. Obviously, I have a pretty good relationship with them. Okay, we have some deals with the other brokerage firms, but the TD Ameritrade rate, it's by far the best one. I know some clients are overseas. If you're overseas, we have ideas to help you as well, because not everybody that's overseas necessarily can access TD Ameritrade. That's okay. All right. By the way, the commissions make the trading, it almost makes the commissions like a non-argument. People are like, oh, the commissions are so expensive. It's not an argument anymore. The commissions are so low, it doesn't even matter. Okay, so keep that in mind. By the way, if you don't have $2,000 in your account, you would have to open up a cash account, and in a cash account, technically, you could trade spreads. So with that, by the way, if you're Canadian, you send us an email, and I'll tell you how to go about, if you're Canadian, how to go about doing this. First question, Jacqueline asks, can't make it live. Will the class be recorded? Of course, class is recorded. And again, you have lifetime access to the on-demand recording. Next question came in from a Michael. Never could get my head wrapped around options. Are you going to be able to follow the class? Absolutely. I mean, Michael, listen, when you come to the class, I do ask this. I think this is fair. Try to watch at least the options 101. It's broken into 5 parts, but at least try to watch the options 101 between now and Saturday. If you don't quite get it, go to the class anyway and then watch the class again. I'm going to tell you guys this. You'll go to the Inout Spreads class. You'll watch the class 3 times. You watch the same class 3 times, and you'll pick up more stuff. You know what I tell a lot of people? You have a 1-month access pass to TheoTrade. Do yourself a favor. Stop watching Netflix or Amazon Prime for 1 month. Just watch videos in here for a month. That's all it's going to take. $199. Okay, it's a little bit more than Amazon Prime for a year, but $199, and I'm telling you, it will save you, okay, a tremendous amount. I know everybody's like, I want to make money. The first thing you got to do, you got to learn not to get killed in this business. All right, that's rule number 1. You walk down to a trading floor, And if you're a young kid like I was, they put $50,000 in an account and they go, kid, go for it. And you go, I don't even know what I'm doing. They go, don't lose money. I mean, it's like rule number one. And people take extraordinary risk. You do these spreads, you don't have to take the extraordinary risk. All right. Next question. Susan said, I don't have much time to trade. I work full time. Can you do this? Yes, actually, the in-out spread of almost all the classes that we teach, the in-out spread, I would have to venture to say, is the most applicable to those of you that have full-time jobs. This one it's such a soft, gentle spread. You can place it, pre-market. You can actually execute good till cancel to get out of it. It's easy. It's a lot easier than a lot of the different strategies. Thomas actually asked, I swing trade stocks. Is this class going to be right for me? Yeah, actually, if you swing trade, you think about this. Instead of actually swing trading stock, just swing trade around the options. Listen, those of you that are swing traders, you might be really good at swing trading. I don't want to change necessarily your directional bias. I'm just going to change your trade logic. That's the fun thing about this is I don't want to tweak everything that you're doing. I just want to tweak your trade logic and how you actually approach the markets because, I'll make you better at some of the stuff you're already doing. And I'll get you through the flaws and the mistakes that you make out there. And that unto itself, okay, is going to be creating a lot more effective trades. So, all right, moving on over here. Another question from Patrick. Patrick actually said, if a six-figure retirement account, you need to make income. Social Security doesn't cut it. I like that. Social Security is probably not going to be around by the time I'm ready to retire. Anyway, can you do these trading strategies in retirement and can you generate monthly income? Yeah. I mean, listen, with the in-out spread strategy, it's about consistency. I mean, that literally was the name of tonight's, using options to create consistent returns. That's what it's about. We're trying to go out there and take very small shots in a very, very big marketplace. Get back and reduce your risk. Now, I've run over time here by about 9 minutes. I want to thank everybody for joining us tonight. We'll be here, okay, to answer some more questions. And by the way, people are still, they're asking about like iron condors and stuff. Listen, we'll be doing that in the chat room. You have a month access to TheoTrade. Of course, I just did an iron condor, yesterday, executed another one today. People are asking rates of success over here. Come, you can check out some of the track record. Actually, Doc Severson has got a lot about track records with in-out spreads. This, okay, is a big league class. You want to check this class out. Again, it's Saturday, February 10th. It's about 3 hours. I'll probably keep you a total of about 3.5 hours. Come to it. I appreciate when everybody does make it live out to the class. Enjoy it on the recording. Again, you've got lifetime access to the on-demand recording. In addition, you also have 1 month, okay, access to everything we're going to do in the next month and all of the coaching archives. Thanks, everybody, again, for joining us tonight. Have a wonderful evening.